Joining me today is Brad Case, NAREIT's Senior Vice President of Research and Industry Information. Brad, your latest research looks at the correlation between REITs and the broader stock market. What did you find?
Well, it's a very interesting analysis. Usually when we're looking at the investment characteristics of publicly traded REITs, we're using monthly data over a fairly long period so that we get an idea of how REITs behave and how they interact with the rest of the stock market over a variety of market conditions. But in some asset classes, we can't use monthly data. We have to use, for example, quarterly data. What we found is that when you look at REIT returns over 1 quarter periods, or 2 quarter periods, or 3 or 4 quarter periods, interestingly, the correlation between REITs and the rest of the stock market actually goes down when you have longer investment horizons. Now, why would that be? If you think of how many people trade REIT stocks, in many cases they're trading through a mutual fund or an ETF that includes non-REIT stocks. For example, the financial sector. REITs are classified within the financial sector, although they're not really financial companies. That means if other investors are trading a financial sector ETF or mutual fund on the basis of information about, for example, banks, that may cause the short-term correlation between REITs and the rest of the stock market, including banks, to be high. But then knowledgeable investors will recognize that REITs may be mispriced, underpriced or overpriced because they've been pulled in one direction or the other by non-REIT information. And that gives an opportunity for knowledgeable investors to make money by trading REITs back to where they should be, regardless of what's happening with the rest of the stock market. That, I think, is what is causing the correlation between REITs and the rest of the stock market to go down as we look at longer investment horizons.
And how does that compare to other asset classes?
Every other part of the stock market, when we look at longer and longer investment horizons, the correlation actually goes up. That means that as mispricings in every other part of the stock market are corrected, the other parts of the stock market look more and more like each other. Whereas with REITs, as mispricings in REIT stocks are corrected, REITs look less and less like the non-REIT part of the stock market.
And we saw the correlations for REITs change during the liquidity crisis, which is to be expected. Now, there's some concern that perhaps that's going to indicate a change going forward. What do you see there?
Sure. If you use monthly data and you look at the long-term average correlation between REITs and the rest of the stock market, it's about 55%. Certainly 10 to 15 years ago, it was less than that. It was down in the 30% range. Over the last 3 years, say, that included the liquidity crisis of late 2008 and early 2009, the correlation between REITs and the rest of the stock market was higher than 55%. Our own analysis suggests that it jumped up to about 71%. Other analyses will suggest that it jumped up to a higher point in the 80% range and then has come down since then. It's useful, I think, for investors to take several different ways of thinking about what is happening to the correlation between REITs and the rest of the stock market to give them a way of predicting what's going to happen into the future.
And lastly, why do you think it's so important for investors to truly understand that REITs are a separate asset class?
Well, fundamentally, if you're talking about two different asset classes, you're talking about two different groups of assets whose values respond to different sets of signals. So REITs, even though they're traded within the stock market, are a way for investors to access a different real estate asset class, because REIT stock prices are affected by signals about the values of commercial properties. Investors who understand that can, as I said, take advantage of mispricings, but also they understand that two different asset classes will tend to have a low correlation, especially as crises pass, and that gives investors an opportunity to have a well-diversified portfolio that still performs well without a great deal of portfolio level volatility.
Brad, thank you very much for joining us. For more on this and other REIT news and analysis, be sure to visit REIT.com.